Okay, capital asset pricing model. So we've talked about this already a little bit. Let's repeat our discussion that when you invest in a stock, you of course want to earn more than the risk-free rate. Otherwise, you can just put your money in the bank, right? Why would you take that higher risk? Because a stock would only be worth something if the company that is selling that stock to you is profitable and the cash flow is positive, right? Or at least is expected to be positive. So there is a lot of uncertainty with the company that is not there in the risk-free rate. So if you are buying a stock of a company, the return you want to earn, the return you require to earn on that should be more than the risk-free rate. But the question is how much more? Well, depends on how much systematic risk is inside that stock, right? If it is equal to 1, well, then what you want to earn is basically how much the stock market pays on average over and above the risk-free rate. So this part is known as the market risk premium. This is known as the market risk premium, that on average the stock market pays a return more than the risk-free rate, which is a premium on top of the risk-free rate. So the market risk premium is that return of the market minus the risk-free rate. And if your beta is 1, which is the beta of the market, then that premium multiplied by 1 plus the risk-free rate is what the return on the market is. But if you want it for a particular stock, well, then you have to plug in the beta of that stock. So that is what your capital asset pricing model is. And why the name capital asset? So what is a capital asset? These stocks and bonds, these are all capital market securities and they are capital assets, right? So how do you price that asset? That, okay, if I'm a company, I want to take some equity financing, right? I can take some debt financing and I'm going to invest in some assets, earn some return on them, and then use that return to pay my shareholders. But to do all of this, I need to sell them a share. What should be the price of that share? Well, it depends on how much return they expect from me and the return I'm able to pay them, right? So to come up with that price, we need to calculate the required return. So the capital asset pricing model is a model which helps us figure out what should be the price of the share that we should try to sell the share at to the investors or the shareholders. And the shareholders are also thinking about this, that is this a good price to buy the share at? And more on that later when we get to equity, that how do we figure out what should be the value of a stock. I'll just give you a little sneak preview into that. So basically the intrinsic value is the present value of future cash flows, which means you take the future cash flows and you discount them back to today, but the discount rate that you use is not the risk-free rate, because these cash flows have some uncertainty in them. They're not risk-free, right? They're not certain. So that's why the rate that you use going forward in your equity readings to discount back the future cash flow to calculate the value of a stock, what is the price of a capital asset. The way you will be able to do that is by using this rate, which is the required return on equity. And how you calculate that rate is through the capital asset pricing model. So there are various assumptions here. Obviously, one, that investors are price takers, but also that fractional trading is allowed, right? Which it is. Which means you can buy half a share, you can buy 1/10 of a share as well. But again, like with all these assumptions, I've been telling you from the beginning of this and the previous learning module that these assumptions are not 100% correct, right? So for example, fractional trading is allowed. Manually, if you were buying a share, you could buy half an Amazon share. But through API, which is application programming interface, through automated trading, algorithmic trading, fractional trading is not really possible in a lot of situations. So again, there is a problem with this assumption. Homogeneous expectations, again, it's not really practical to assume everybody will have exactly the same expectations. Yeah, majority of the participants might. Like for example, at any given point in time, you can do a survey of leading market participants that what are their expectations with respect to the Federal Reserve, increasing the interest rate or decreasing it, or if they're increasing, then increasing by how many basis points. So you'll see that majority of the participants do have a similar expectation, but it's not that everybody has the same expectation. But this is one of the assumptions of the capital asset pricing model, which is also an assumption of the capital market line, that everybody has similar homogeneous expectations, and that's why the market portfolio is the best portfolio. Also, this is capital asset pricing model is assuming a certain beta based on a certain historical data set, that okay, this has been the return of the market, this has been the return of this stock, this is the scatter plot, and this is the slope, right? So the beta is the slope, and how you calculate that slope is the covariance divided by the variance of the market, and that slope is at a certain point in time, right? It can change in future. So again, I mean, you're assuming a single holding period, but reality could be there could be multiple holding periods, things can change. Frictionless markets, which means no transaction cost, which is also not true. Even though we are in a world today where operationally the costs are very low, so operationally the market is very efficient, but it is not frictionless. And yes, again, another assumption which is very, very true, but maybe not 100%, because you might have some people who are gamblers, right? So there might be some people who are risk seeking, some people who are risk neutral, but I would say 99% people are probably risk averse, right? Who are trying to maximize their utility and are rational, right? So let's apply the capital asset pricing model. The standard deviation of returns is 25, correlation with the market is 0.6, standard deviation of the market is 0.2, expected market return is 10%, risk-free rate is 3%. What is the FFC's expected return? Let me just help you out a little bit over here. If you don't need my help, just pause the video and try to solve it if you think you can handle this. If you are not able to wrap your head around it, let me just help you out a little bit. That correlation is equal to covariance divided by the two standard deviations, right? They've given you the correlation, they've given you the two standard deviations, so you can actually calculate the covariance, and then once you know the covariance, well, then you can, you know, the variance of the market. Through the standard deviation you can calculate the variance, and then that will help you calculate the beta, and then once you know the beta, well, return will be risk-free rate plus beta into market risk premium, right? A very common mistake I've seen students do is that they plug in the return of the market as the market risk premium. So that's a mistake. The market risk premium is the return of the market minus the risk-free rate. It's just the premium, right? So be careful with the return. You have to calculate the premium. And a lot of students I've seen do the opposite as well, that the question is directly giving them the premium and they minus the risk-free rate again. So be very careful with this. If the question says premium, that's already market risk premium. Also, another word that they can use for this is equity risk premium. It's the same thing. Equity risk premium, market risk premium, both mean the same thing, that it's the stock market or the equity market which pays you a certain premium over and above the risk-free rate. So if they're giving you directly the premium, you can plug it in. If they're giving you the return on the market, well, then to calculate the premium, you should have to then minus the risk-free rate from that. So I think I've said enough. Please, if you still haven't paused the video and solved this, pause the video and solve this and tell me what is the return that one would expect, or even I would go to the extent and say require from this investment, right? So what is it? Yes, you're absolutely right. It is 8.25. And how did we get that? Well, first we calculated the beta. How did we calculate the beta? Well, you need to know the covariance and the variance of the market. Variance of the market is, so let's first calculate the covariance. You first plug in the correlation. Correlation is how much? 0.6. So let's plug that in. Then is equal to covariance, we don't know, we'll calculate that. Standard deviation of the market and the standard deviation of the stock is known to us, so that is 0.25 and 0.2. Now let's take these on the other side. So 0.6 into 0.25 into 0.2 is equal to covariance, and beta is equal to covariance of the stock in the market divided by the variance of the market. So we already know the standard deviation of the market is 0.2 and it's squared, so I'll just write 0.2 twice, right? And then the covariance I will write like this, which is 0.6 into 0.25 into 0.2. The 0.2, 0.2 I can cancel, and then what I am left with is this part, which is 0.6 into 0.25 divided by 0.2, which gives me the beta. Now I can plug in the beta over here. The premium, market risk premium, is the return on the market, which is 10%, right? 0.1 minus the risk-free rate 0.03 multiplied by the beta of 0.75, and this I will add on top of the risk-free rate, which is 3%, to get my required return or expected return on the stock. Now guys, security market line is made with return on the y-axis but beta or systematic risk on the x-axis, right? So what we have been seeing so far with the capital market line, capital allocation line, etc., is that we have been taking standard deviation or total risk on the x-axis and return on the y-axis, right? But now we're taking beta, and obviously with the efficient frontier and everything, as you were increasing your total risk, the return wasn't really increasing with that, right? Unless you just stayed focused on the market portfolio and then just kept investing in the market portfolio only. And if you wanted to increase the risk, well, you could borrow and do it, but the investment would still go into the market portfolio and not in anything else, right? So that then would have that very nice 45-degree angle. But now here with the security market line, your beta is the x-axis. The x-axis is beta, so you don't need to worry about other portfolios over here. Now, why is this so important? See, first of all, from an exam perspective, you need to know that while the slope of the capital market line was the return on your optimal market portfolio minus the risk-free rate divided by the standard deviation of the market minus, well, 0, the standard deviation of the risk-free rate, which is 0. So this is your y2 minus y1 over x2 minus x1, right? But now on the x-axis, it's not standard deviation. It's actually beta, right? So, and if you want to know what is the slope of the security market line, it is the return on market minus the risk-free rate divided by the beta of the market, which is 1. So essentially, the slope is just the numerator here then, because the beta is 1, and the numerator is the market risk premium. So the slope is basically the market risk premium, the slope of this security market line, which basically says what? It says for every 1 unit of beta that you take, this is the extra return that you make, right? So this is the run, this is the rise. So for every 1 beta, this is the extra return you make. So for example, if a stock has a beta of 2, which says what? Which means what? It means that the stock is twice as volatile as the market, not in terms of standard deviation, but in terms of the variance of the market itself. So that if the market goes up 1%, that stock goes up 2%. If the market comes down 1%, that stock goes down to 2%. And I mean, I don't want to give any examples, but just as an example, let's say Tesla, right? So and you know, a safer stock would be, let's say, Coca-Cola. So the market can crash 1%, but Coke will only crash 0.5% because it's on. See, the market has everything inside it. It has Coke, it has Tesla, it has Google, Apple, Microsoft, I mean General Motors, whatever, right? Everything, all the big companies, S&P 500, whichever is inside the S&P 500 is probably the market. That's what we take it as a proxy, right? So market theoretically includes all risky assets, but even if we take S&P 500, it has so many different stocks, some of them which are more volatile than others. So market might be falling 1%, but Coca-Cola might not be falling that much, right? Because it's more stable than what the other stocks are there inside the market. And then Tesla might be falling 2%, right? Just an example. So that it's more volatile. It's having a higher beta. It's more sensitive to systematic risk. It's more sensitive. So let's say what are macroeconomic factors, right? What did I tell you is systematic risk? It's basically macroeconomic risk. Macroeconomic risk includes, let's say, business cycle risk, that okay, if the business cycle is slowing down, right? And think about your economics material where there's business cycles. So people might not buy a new car in a recession, but they still might continue to drink Coca-Cola, right? So Coke is less sensitive to macroeconomic factors. Tesla is more sensitive to macroeconomic factors. So therefore, Tesla has a higher systematic risk inside it. So I hope you get the point, right? Now, why is the security market line so important? First of all, it doesn't take total risk on the x-axis, it takes beta. So we're kind of getting rid of all that unsystematic risk and all this total risk stuff, and we are only focusing on systematic risk because that's what really matters, right? And then you could really use this security market line and apply it to any security. So for example, if as per my security market line, the return on the market is 10%, and obviously market has a beta of 1, right? And the risk-free rate, let's say, is 5%. So if I am buying a Tesla stock and assuming just for 1 minute that Tesla has a beta of 2, well then what should be the return it should give me? Very simple, risk-free rate plus the beta into the market risk premium. So that's going to be, market is giving me 10%, risk-free rate is 5, beta is 2 plus 5. So this is 10 minus 5 is 5 into 2, that's 10. 10 plus 5 is 15, right? It should give me 15%. Now, if it is, let's say, giving me more, if I see that it is actually giving me a higher return, then that means that the stock price is undervalued, right? Only then it will be giving me a higher return than what it should be. Now think about it, that's a little counterintuitive. You might have a little difficulty in wrapping your head around that concept. But if something is giving me a higher return, let's say if the stock price was 100 and the return it was giving me was $15, right? In that case, it would be 15%. But if I'm actually getting 17% on this, well, there is only two possibilities. Either it is giving me a higher return or the price is low. So assuming that the dollar amount of return is not higher, it's the price which is lower. So that means the stock is undervalued and I should buy it because it's going to pay a lesser return, which means for the only way for it to pay a lesser return is that the price will go up. Assuming for a minute that whatever earning it is giving you is not changing. So the only thing which is a moving part in the short term is the stock price going up. So I should buy it. Now, why is that counterintuitive? Because it's above the SML. Now, what you have to consciously remember is that those stocks which are above the security market line are undervalued, and with the ones which are below. So let's say Coke is here and it has a beta of 0.5 and it should be giving me this much return, but it is giving me this much return, right? So then Coke, I would say, is overvalued. It's overvalued. So below the security market line is actually overvalued and above the security market line is undervalued, right? Differences between CML and SML. Obviously, the most obvious difference is your slope of the line. Here, first of all, the way I would write it, if just to compare the slope, is I would flip these two around. So that will help you understand. So the way I would write is that RF plus RM minus RF, because that's the slope, multiplied with the beta, because beta is basically the X value that you're putting in, right? You have beta on the X axis and return on the Y axis. And here, standard deviation is on the X axis. So let's have it presented in a way that it's easy for us to compare, where this is the X, right? This is the X and this is the slope. This is the slope, right? And the slope of the SML is basically this divided by 1, and we've discussed that before, because obviously the market, if you take Y2 minus Y1, so that's the difference between the return on the market and the risk-free rate, and then 0, and then beta is 1, so because there's 1 in the denominator, so we don't write it, right? But here obviously the standard deviation of the market is not 1, so that we are writing. So the key difference between these two is basically the slope. And of course, the X value is beta here, and the X value here is standard deviation of the portfolio. So those two things you really need to remember, right? That is the critical difference between your SML and CML. Right, now to make sure you're able to actually apply these concepts and solve questions. So this guy is investing 10% in a risk-free asset, 40% in a market fund, 50% in a high-risk stock with beta of 2.5. Risk-free rate is 5%, expected market return is 10%. What is the portfolio beta and expected return? Please pause the video and try to solve this. And then I will show you two different ways of solving it. And then let's see which one you actually used. Right. So if you still haven't paused the video, please pause the video and try to solve this. Alright, so the way I would solve it is probably with the alternative method. I would first calculate the return on this particular stock, given that its beta is 2.5, right? So that's how I would start solving this. I would plug in that beta. I would take the market risk premium. So market is paying 10%, risk-free rate is 5%. So I would take that and then calculate the premium and add it on top of the risk-free rate, and I would calculate that, okay, the expected return from this stock is 17.5. I'm putting in 50% into this stock, so I would give a weight of 50% and multiply that to the return I expect from this stock. 40% I'm putting in the market. Market is 40% into the return that the market is giving, which is 10. So 0.4 into 10, and then I'm putting 10% money in the risk-free, which is giving me 5. So I just take a weighted average approach and it would give me the return on my portfolio. And as far as the beta is concerned, well, I'm going to again take a weighted average approach for that as well. So that you can see over here in terms of the beta, that calculation will be 50% going in a 2.5 beta, 40% going in a market portfolio, which is obviously a beta of 1, and 10% going in a risk-free asset, which has a beta of 0, and then you just calculate the weighted average for that. Right. So, and then you could start with this, and then you could say, okay, so my entire portfolio beta is 1.65, and then you could just calculate the return for the entire portfolio by plugging in the beta of the portfolio, multiplying it with the market risk premium and adding that to the risk-free rate. So both approaches are correct. Now, as I was telling you, that capital asset pricing model is used in both corporate issuers and also in equity. So from the corporate issuers perspective, obviously you're looking at things from the company's perspective that is getting this financing from shareholders and from debt holders, and it is then looking to do some in capital projects, capital investment projects. So this whole process, as you will learn when you get to corporate issuers, is known as capital budgeting, that we look at different projects, we see what is the return we can get from these projects, what is the cost of our capital. So you will see that this RE, which is the required return or expected return on equity, will also be written at times as KE, because it's the cost for this capital from the company's perspective, right? But it's the required return from the investor's perspective. So the required return on equity is actually the cost of equity from the company's perspective. And of course, there'll be a cost of debt, which is the required return on debt, as you will see later on. So your capital asset pricing model really helps you figure out what should be the return that should be expected by the investor and has to be paid by the company. And then that will help you discount future cash flows, right? So when you want to know what is the future cash flow value today in terms of calculating the value of a stock, well, the rate you will use is not going to be the risk-free rate. As I told you before, it's going to be your required return on equity, based on the riskiness of those cash flows. And how do you estimate the riskiness of those cash flows? Well, it depends on how much systematic risk that business has, how exposed to macroeconomic risk, business cycle risk, exchange rate, inflation, etc. does that business have? How much exposure does that have? So how is that captured? How is that risk captured in this discounting process? Is that this return on equity is not just the risk-free rate, it is something which is added on top of that, which depends on beta and the market risk premium. So I hope this is all now very clear for you. Now, certain assumptions are there. Because of that, a lot of limitations are there, and therefore then we have some other models which are in more detail covered at level 2. At level 1, you just need to know what those models are. And before I tell you what those models are, let me first tell you what are the limitations of capital asset pricing model. Well, number one limitation is that it only has one beta, right? Now at level 2, you will learn about models which have more betas, right? So you can take that systematic risk and you can break it up into, let's say, okay, so what is this business exposed to in terms of interest rate risk, in terms of inflation, in terms of, let's say, business cycle risk, right? So inside the market risk, inside the systematic risk, there could be further sub classifications, and then you could have multiple factors, and that's where the other models come into play. Number one. Number two, the other limitation, and these are both theoretical limitations. So the second theoretical limitation is that, again, it's a cross-sectional sort of a thing, that it's like beta at a given point in time, and it's based on past data, and you're doing a prospective sort of a situation where you want to know the future. So again, it's a theoretical limitation, which then also shows up in reality as well. That capital asset pricing model actually has been a poor predictor of returns. That what the model said, that this is the return that a company should pay, or the investor should require from the company, but the reality has been different. Maybe the investors have required more or less. So, don't get disheartened that, you just understood this wonderful concept and you might be feeling that, okay, so then it doesn't work. Well, it does work, right? It's just that you need to apply it with a little bit more sophistication. So you're just at level 1. At level 2, you're going to learn how to actually expand that beta into multiple different betas, and I'll just show you right now that what it looks like. So there's two very, very interesting modules that you will learn, right? One is called the arbitrage pricing theory, which breaks up this entire concept into multiple betas, and there are some very fascinating existing models that have been developed as expansions of beta, where they've taken that beta and broken up into companies which are small minus big, high minus low, depending on, okay, how does it impact smaller companies, how does it impact companies that are having a higher momentum. And then, so this work, by the way, was done by also some very, very well accomplished people, Pharma and French. So it was Eugene Pharma, Kenneth French, right? So Pharma and French, you'll learn about a lot as well. And then the Carhart was add-on to this. So they still took the market and the small minus big and the high minus low. And then they also added the momentum factor. So that's the Carhart, which added the momentum. But again, don't worry about this too much right now. This will be covered in level 2 in more detail. I'm just telling you that number 1, as far as level 1 exam is concerned, you just need to know that these exist. And number 2, this is a very, very interesting space. So, going forward, there is so much work, and this can, tie in with your linear regression and multiple linear regression, because that's basically what it is, right? If you remember your linear regression equation, it was y is equal to b0 plus b1 x1, and then obviously there is an error, but that b1 is basically saying that there is only one single factor, right? But you can go for a multiple linear regression, if you remember your quants material, that you can have x1 but then you can have x2 as well, which means you can have b1 and then you can have b2 as well. So that is where a lot of the new work in terms of data science and predictive analytics and machine learning is going on. So keep your motivation high, and for the time being, focus on passing the level 1 exam. Now, what are the other limitations? Of course, market portfolio. From the beginning, I've been telling you that the market portfolio theoretically is supposed to have all risky assets, but practically, the best thing we probably have as a proxy of the market portfolio is S&P 500. Now, of course, that covers almost a lot of the different parts of the global economy, right, through the companies that are there in S&P 500. But does it take all of the global economy? Well, of course not. So that's why we use it as a proxy, but then that is a practical limitation. That's the best we've got, right? And then again, when you try to estimate your beta, what is beta? You will take a return of market and return of the stock and then see its covariance divided by the variance of the market. But what are you taking as a proxy for the market? The S&P 500. So again, the estimation of beta is through this process of covariance divided by variance, and then to do that you need to take a proxy for the market. And last but not least, that you're assuming that everybody has similar expectations, which is true for the most part, but not 100% true, right? So, guys, now what does all of this mean for practical application? That okay, so if you're working as a portfolio manager, or you are wanting to become one of the best portfolio managers one day, what do you think is that number one thing on your CV that hedge funds or whoever wants to hire you is going to look at? Well, to start with, it's the Sharpe ratio. And what does the Sharpe ratio basically mean? Now, going back to your capital market line, right, where you had your standard deviation here and your return over here. And then we're saying, okay, this is the risk-free rate, right? And let's say this is the market portfolio. And in terms of standard deviation, this is how much return excess risk I'm taking compared to the risk-free rate, and this is how much return I'm making over and above the risk-free rate. So what the Sharpe ratio basically tells you is how much return you are making. If I just were to calculate it for the market, that how much return the market is giving me over and above the risk-free rate divided by how much standard deviation is there in the market. So it's essentially excess return, right? Why I'm using the word excess? Because it is over and above the risk-free rate. So excess return divided by excess risk. That's what it is. Now, if I want to do this for the portfolio, all I have to do is, instead of M, I just have to write P. That this portfolio manager, how much return is he or she generating for me over and above the risk-free rate? Because I can do that on my own. I can put my money in the bank and earn the risk-free rate at zero standard deviation. So you are offering me something more, right? The portfolio manager is offering me something more. How much more is that from the risk-free rate? So what's the excess return divided by how much excess risk I'm having to take, right? And I don't write the minus zero because obviously there's no need to write it, but it's very much there. And that basically tells you that per unit of risk, how much excess return this is generating. Now, it's very good. And to be honest, this is probably the number one thing that you need to have on your CV, on your resume, because if you want to get hired by a hedge fund, this is the most important ratio. But theoretically speaking, this has two limitations. Limitation number one, it is using total risk. And as far as theory is concerned, we want to do this based on systematic risk. So the exact same situation is there, where instead of total risk, we are taking systematic risk. And then the same situation that, okay, how much excess return you are making per unit of systematic risk. So that is where your Trenner ratio comes in. But practically speaking, two very important points I would like to say over here. Number one, as far as the exam is concerned, what you have to remember is that if you are trying to calculate the ratio to know excess return over excess risk for a portfolio manager who has a concentrated portfolio, right, which means that they haven't diversified enough, so they actually need to be evaluated based on total risk because, well, they haven't diversified the portfolio enough. However, if you are trying to evaluate a portfolio manager who has already diversified their portfolio, in that case, then it's better to check their Trenner ratio. But then check their Trenner ratio and do what? Or check their Sharpe ratio and do what? I mean, what are you going to compare it to? You need to have a benchmark, right? So the problem with both these ratios is that they're not informative in themselves. You need a benchmark to compare to, and I'm just going to tell you the solution for that as well. I'll tell you one for total risk and one for systematic risk. But before I do that, let me just repeat this point that I said, that if you're dealing with a portfolio manager who has a concentrated portfolio, then Sharpe ratio is the way to go, or a total risk approach is the one you should take. And similarly, if there is a portfolio manager with a diversified portfolio, then the beta approach or the systematic risk approach you should take. And the second point I wanted to tell you is that practically in the industry, Sharpe ratio is the one that is monitored most. Maybe because many of the portfolio managers are having concentrated portfolios, or as a third party evaluating somebody's ratio as a performance appraisal, you don't know what's inside their portfolio. So to give them the benefit of the doubt, you'll just say, okay, let's just evaluate it on total risk. And we can compare all different managers on the basis of total risk, because you don't know what's inside. Is it concentrated or diversified, right? Now let's solve the second part, that how to compare it to a benchmark. So if you're in the world of total risk, well, you can do something called M square. Now what is M square? M square is saying, okay, how much excess return you're generating, right, over and above your excess risk which you are taking, multiplied by the market standard deviation, right? So what does that tell you? It tells you that, okay, as far as your risk is concerned, how much return you are generating. So your excess return over your excess risk, which basically gives us, for every 1 unit of standard deviation that you are taking, how much return you're generating. And then when I multiply it with the standard deviation of the market, I get that how much return you would generate if you took the same risk as the market. And then I minus how much the market basically generates for me when I take that risk of the market. So if you're making more than that, right? So if your M square is positive, then you're basically saying that if I took the same risk that is there in the market, my return would be higher, which means if this is, let's say, the market standard deviation, and this is the return the market is giving, taking the same standard deviation, you would get a higher return. That's what M square, a positive M square, tells you. But still the limitation is there, that it is, okay, the first part is not there, which was that the ratio in itself is not informative, but now it is, because you've got a benchmark to compare it against, which is the market. But it still uses total risk, which is not really a limitation if you want to apply this to a concentrated portfolio. But if you want to apply this to a diversified portfolio, well, then that is where alpha comes in. And alpha is just basically the return on the portfolio minus the return that you would expect to earn from that portfolio. And how do you know what return you expect to earn from that portfolio? Well, it's just the capital asset pricing model, that depending on the beta of the portfolio, right, what would be the return you would expect to earn from it by taking beta multiplied by the market risk premium, which you can see over here is the return on the market minus the risk-free rate plus the risk-free rate. And that tells you what would be the required return that you would expect to earn and what is the return you're actually earning. And if there is more, if this is positive, well, then you're generating alpha. Okay, let's take a break here. We'll come back and talk about the applications of the capital asset pricing model in portfolio construction.